Across the globe, millions of square feet of hyper-modern server space are spinning up to power the artificial intelligence build-out. This infrastructure requires a staggering physical operation and massive amounts of electricity to sustain. But a paradox is emerging. The hardware giants behind this build-out are posting record-breaking profit surges, while their stock prices plummet on the news. In one instance, a top memory maker multiplied quarterly profits 19-fold, only to see its stock crater 11% intraday, tripping market circuit breakers in Seoul. This chart of the CBOE Nasdaq Volatility Index, or VXN, shows volatility hitting 2-decade highs relative to the broader S&P 500 VIX. Nasdaq 100 constituents are now moving in unusually tight synchronization with each other, while simultaneously breaking their historical correlation with the broader market. This tightening correlation indicates that balance sheet capacity across the global buy side has reached exhaustion. Institutional players have run out of room to fund the trade. Because portfolios are maxed out on these positions, record earnings reports function as liquidity traps. They trigger a mechanical rotation out of the builders and into the next phase of the cycle. To understand the next phase, we have to look at the scale of capital projected for AI hyperscaler expenditures over the next 3 years. Projections show roughly $800 billion flowing into infrastructure in 2026, stepping up to $1.2 trillion by 2027. These figures carry significant macroeconomic weight, representing 2.5% of U.S. nominal GDP in 2026, and scaling to 3.6% in 2027. A capital injection of this magnitude transforms a technology trend into a massive aggregate demand shock. This shock remains concentrated at the top of a K-shaped economy, flowing primarily through elite technology firms and energy providers. Directing 3.6% of GDP into specialized physical infrastructure creates an inescapable structural floor for inflation. The market is currently mispricing this environment, anticipating a return to pre-pandemic inflation norms rather than a new era of sticky inflation. Navigating this shift requires moving away from the crowded mega-cap tech trade to prepare for the consequences of sustained, above-target inflation. If a $1.2 trillion demand shock is driving sticky inflation, logic suggests the Federal Reserve should simply hike rates to cool the economy. However, the interest rate-sensitive bottom half of the consumer economy is exhibiting localized recessionary conditions. This chart compares AI Capex hypergrowth against deteriorating average household credit. Auto and credit card delinquencies are hitting global financial crisis levels. This divergence creates a trap. Raising rates crushes the lower-income consumer without deterring the cash-rich hyperscalers driving inflation. The policy rate has become the wrong tool for an inflation vector driven by corporate technology spending. Instead, the Fed is pivoting to balance sheet mechanics, like quantitative tightening, to manage bond markets directly. QT allows the Fed to project inflation-fighting credibility to lenders without triggering a deep consumer recession. The net result of this delicate balancing act is a Fed that must effectively look through the sticky inflation created by AI. This combination of unabated AI spending and a paralyzed Fed guarantees prolonged inflation, forcing capital to seek yield in previously ignored sectors. The sudden realization of this sticky inflation environment will expose structural fragilities in a market currently priced for perfection. This chart tracks systemic leverage via margin debt. The peaks of 2000, 2008, and 2021 connect via the 1.618 Fibonacci multiplier. Current levels align perfectly with a 1.618 projection from the 2021 peak, indicating maximum cyclical extension. This fragility is compounded by the options market, showing heavy negative gamma exposure between index levels 7,400 and 7,500. This triggers mechanical selling from market makers as the index drops, creating a self-reinforcing downward loop. This forced selling operates entirely independent of economic reality or company fundamentals. This combination of tech euphoria, high margin debt, and liquidity constraints closely resembles the summer of 1998, a period defined by a sudden, violent liquidity wipeout. In 1998, a 20% rally in the first half of the year was followed by a sudden 20% wipeout, triggered by macro shocks in Russia and the collapse of long-term capital management. That crash only ended when a rapid, dovish pivot from the Federal Reserve created a vicious V-bottom. Portfolios must prepare for a severe but transient risk-off event, a clearing of the decks required to start the next leg of the bull market. Once the liquidity shock clears, capital will shift toward technology diffusion. This principle states that the highest absolute returns eventually move away from the creators of a network and flow towards its adopters. We saw this diffusion after China entered the World Trade Organization in 2001. The WTO provided a unified global market, granting immediate structural leverage to the periphery and driving international equities to outperform the U.S. by 500 basis points. We saw it again with the 1992 Maastricht Treaty and the creation of the euro. A common currency and monetary policy forced peripheral economies to rapidly align their metrics with core market leaders. In the 1990s, Italian bonds violently compressed a 700 basis point spread to match German yields, simply because they gained access to the same structural system. Today, AI operates with the same systemic force as the WTO or the euro. It is a unified productivity layer available to the global periphery. Just as credit spreads compressed in the 90s, AI adoption will force a historic compression in gross margins and valuation multiples between the Mag 7 and the rest of the market. This rotation requires using the Mag 7 megacaps purely as a source of funds. Capital must be rotated out of the reservoir of megacaps and into equal-weight S&P funds, midcaps, and international equities. These sectors are the ultimate adopters of AI. Their free cash flow is poised to accelerate while their hardware costs remain low. The Fed's current internal task forces strongly point to a dovish monetary reaction by late 2026 or early 2027. When sticky inflation meets explosive productivity gains in the periphery, the market is forced to price in extreme right-tail risk, setting the stage for a sharp upward repricing. Success in the next decade depends on skating to where the earnings growth is going. Surmounting the coming liquidity shock requires harvesting profits from the builders and letting the gravity of valuation compression do the work.